Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. Markets' attention shifts toward the end of the week with the first U.S. presidential election debate, and inflation data hits the deck. Tech firms race to team up. AI partnerships are said to be brewing between Apple, Meta, and Google, ByteDance, and Broadcom. And China and the EU agreed to hold talks on tariffs around electric vehicles. A very good morning. You're going into week number 4 of gains for these markets. Over 18 billion shares changed hands in the triple witching. That's about 55% double nickel higher than the average over the past 3 months. But I bring you to the one beautiful phrase from Ed Yardeni. There's NVIDIA, by the way. Your morning check, down by 0.6%. It lost $220 billion in value in the space of 2 days, down 6.7%. It's merely a fissure. It is not a flesh wound. But I bring you to Ed Yardeni. It's the roaring 20s, baby. We're not scrambling to upgrade our targets. They go for 6,000, easily slotted in for the end of the year, the end of next year. They're going for 6,500. But by the time you get to 2030, they're looking at 30,000. No, they're not scrambling. When it comes to the other deals out there, Broadcom and ByteDance, we understand, are getting together to develop a new AI chip. To the bond market, it's going to be about the issuance. How much appetite is there for 2s, 5s and 10s, a total of $183 billion in new issuance. But it all comes down to the bulls being ravaged by self-doubt. And they're going to need the PCE to come in on Friday at around 0.1% to embolden this trade below 425. When you're ravaged by self-doubt, why would you pick up duration at this stage? So pretty reasonable size of issuance to come this week. Dollar yen, again, back in the danger zone. The danger zone is around the 160.17 area. That's where they That's where they intervened before. And again, this is just a prevarication. The Vice Finance Minister, Kanda, has made it very, very clear. Excessive moves, and we will take the appropriate action. So that is your sweep of assets as we kick off this Monday morning. But as we head into the second half of the year, markets are now at a crucial point. Gerry Fowler of UBS, my next guest, says this: we don't see extended positioning broadly, although some of the AI stocks are very crowded. Well, that's stating the obvious. The low correlation, volatility, credit spreads environment is fueling plenty of appetite for risk. He joins us now. Gerry, good to have you with us. So, I mean, a fairly bullish footing, one could say. I've got different calls for 6,000 on the S&P 500, and I've just reminded our audience of what Ed Yardeni said, reminding us it's the roaring 20s, baby. So what needs to stay in place to deliver this pro-risk appetite that you've got? Good morning.
Yeah, good morning. Thanks very much. Well, what really needs to stay in place is that we continue to see what looks like a burgeoning Goldilocks, that inflation comes down and that allows rate cuts to alleviate some of the pressures that parts of the economy are feeling, and that happens before we start to see more negative consequences of higher for longer rates, that we don't have a credit cycle, in which case this will feel like a very large, a very significant mid-cycle slowdown in a much more elongated cycle.
So how dependent are you on rate cuts? I mean, we can endlessly debate every Monday morning as to whether it's 1 cut, 2 cuts, no cuts. I mean, it is nauseating, but how much difference does 1/2 cuts make in the United States of America? Because it looks like other central banks may well outpace the cutting ability of the Fed.
Yeah, so I mean, around the world, rate cuts will make some difference to the profitability of certain firms and households that have debt exposure or sensitivity to those front-end rates, very short maturity rates. But really, the other thing that it does is alleviates the risk to markets, which comes from inverted yield curves, because the valuation of equities is much more reliant on long-term yields, like 10-year yields, which are currently a lot lower than central banking rates in general. So to some extent, unless we get rate cuts, you may start to see investors start to worry about that negative carry and that much lower yield that they're receiving on longer duration. And if those yields were to rise, and especially in the US to rise up towards where those overnight rates are from the Fed, it would put a dent in the relative appeal of US equities relative to others, especially relative, in comparison to what you'd be able to achieve in relatively risk-free assets long term.
So you're in the United Kingdom. Obviously, politics is front and center there. Across the channel in France, we've got another poll, another poll showing Marine Le Pen extending her hold on the electorate. I've seen the flow out of Europe for 5 straight weeks. Some would say that the institutions were prescient, they were ahead of the herd, they got out before the sort of the bloodiness of politics came home to roost. You say there is a low contagion risk, and you consider French stocks a buying opportunity. Are you brave enough to buy French banks?
We are. In fact, some of the French banks have really become very discounted on what is primarily a reassessment of risk premia. Perhaps some of that is justified in that we came from a very low level of risk premia, and so some normalization may be appropriate. And in addition to that, as we head into 2025, there is some concern around fiscal contraction as countries like France and Italy might need to go into deficit reduction procedures. But broadly, the overreaction of the market to the French election in terms of raising the risk premia in Europe broadly does seem a little bit overdone to us. If you look at the premium of European volatility to US volatility, it's back to levels that we haven't seen since prior to 2017 when Macron was elected president of France and ushered in an era of really quite similarly low risks between Europe and France. You know, this is back in the day when the Brexit vote happened, when there were lots of European crises on a rolling basis through the prior 7 or 8 years. And so that level of risk premium in Europe just doesn't seem warranted on anything other than a short-term basis while markets digest the potential election outcomes.
And again, let's circle back to probably where we started, which is to talk about rate cuts. I know that you've raised your target on the overall European metric, to European stock 600 by 20%. But again, how much of that, Gerry, is to do with, look, man, we didn't crash into a tragic recession, or is it to do with, again, the narrative around rates?
Yeah, it's a little bit of both in that there has been a remarkably resilient performance of growth in Europe through what has been a war and an energy crisis. That still kept growth at zero or very close to zero in Europe for the last few years. But now that's improving. And as we're now getting ECB rate cuts, we're expecting that to continue to improve. In fact, we'll probably go from about 0.5% growth this year to about 1.5% growth next year. So there's this nice improving trend of growth. At the same time, you've got disinflation and rate cuts that will, hopefully bring yields down as well and allow valuations to re-rate. So all of this points to an environment of reasonably low risks, quite low tail risks in Europe in comparison to the last few years, which really justifies at this point the valuation of the European market being north of 14 times forward earnings. And that sort of puts you somewhere above 540, potentially up to 570 if you get up to a very benign Goldilocks scenario in a European recovery. It's not to say Europe's without risks, especially going into 2025, but those risks have really dissipated over the last year. The worst case scenario isn't happening, and we're going to get rate cuts before we get a credit cycle.
Okay, Gerry, thank you very much for joining us, setting up the risk agenda this Monday morning. It is all about the shape of those yield curves in perpetuating risk here in the US. Gerry Fowler of UBS. Other stories trending on your Bloomberg terminal as we sit down for Monday morning. Israel's winding down its Gaza operations as the focus shifts to Hezbollah. China's fiscal income drops at the quickest pace in more than a year, and Bitcoin extends the drop after one crypto's worst weeks of 2024. Coming up in the show, China and the EU agree to hold talks on the bloc's plan to impose hefty tariffs on electric vehicles. On the electric vehicle imports, I should say. More on that story next. And a little bit later in the hour, we catch up with State Street's Marvin Loh on why the Fed will continue its higher for longer campaign. It's different this time. Context matters on Bloomberg. Monday edition of Bloomberg Brief. I'm Manus Cranny in New York. China and the European Union have agreed to discuss the bloc's plans to impose additional tariffs on Chinese EV imports. They include taking levies to as much as 48%. Now, this comes as the German Vice-Chancellor, Robert Habeck, wraps up his trip in Beijing. For more, let's bring in our trade czar, Brendan Murray. Brendan, good to have you with me again. I mean, tariffs are sort of, a byword for all nations' relationships with China at the moment. What is Habeck hopeful for from the European side? What's at stake here to try and de-escalate this?
Yeah, I think exactly. He's trying to sort of turn the temperature down and make this more of a consultation rather than a negotiation or, some sort of debate between the EU and China. There are two very different expectations going to come from these talks. On the European side, they're going to look at these as consultations, a very sort of low temperature way to explain to the Chinese how they came about these tariff levels, how these tariffs will have to comply with the World Trade Organization. On the other side, from Beijing, they're going to be looking to try to poke holes in the methodology that the EU used, and ultimately to try to take this time to divide and conquer the EU member states. Germany there's a lot of opposition to the EV tariffs in countries like Germany. Mm-hmm. So the Chinese side will try to exploit that and ultimately try to head off the tariffs when they're due to come into effect in November.
Yeah, and in terms of the Chinese side driving for this, I mean, what exactly are they want? I mean, we've seen spats over cognac, we've seen spats over dumping into China on that. There's been accusations on both sides. So if I said to you, well, what are the Chinese side driving for in this? What is it that they're bargaining for?
Well, you're gonna hear lots of threats about retaliatory efforts on European, as you mentioned, foods and liquor and anything that would sort of help grab a headline to various industries and electorates in the European across Europe. We've already heard some of those products, and the producers of those in Europe mm-hmm. are already not happy about it. So. We're going to see the Chinese. It's a replay in many ways of the solar industry's issues back about 10 years ago or so. That China has used that playbook before and probably will again.
Brendan, thank you very much for setting it up so eloquently. Brendan Murray there on the latest discussions between Germany and China. From EV to AI, Meta held talks, we understand, with Apple about a possible AI partnership. That's according to the Wall Street Journal. The company is looking to integrate its generative AI model into the newly announced Apple Intelligence, the holy grail, getting a hold of all those iPhone users. Tom McKenzie is with me. I was reading Dan Ives' note from Wedbush. The gatekeepers of consumer AI, that is Apple, and that is the ultimate driving force for these potential deals that we're seeing.
And that is exactly why you're seeing the likes of OpenAI, of course, signing a deal with Apple, and now the news, again, reported by the Wall Street Journal, that they are having conversations with the like of Meta. Interesting, given that Meta has had a challenged relationship. It relies, of course, on Apple's hardware and platforms, the iPhones and the iPads, in order to get its apps out there. But we know that they've had a challenged relationship in terms of what Apple's done that has restricted their ad revenue in terms of the targeted advertising part of the business. But they're having these conversations, again, according to reports. Meta has its own models, the Llama models, so it's about integrating those models into Apple's products. The reporting as well from the Wall Street Journal also suggesting they're having conversations, Apple, with the like of Perplexity as well as Anthropic. So they're keeping their options open, but as you say, this would on one level be a massive gain, you would have thought, for Meta to have access and get its models into the hardware of Apple and all of its products.
Yeah, I mean, just looking at some of the data, 2.2 billion iOS devices, 1.5 billion iPhones, Tom. So you begin to understand then why, for example, Wedbush are saying, look, over time, you're looking at a $10 billion trickle-back effect to Apple. Let's talk about the other narrative, which is around the world of chips, the one that you know well. Great videos, great Instagram. If you haven't seen Tom and his big board, you got to tune in for it. They've got all the resources in Europe. I've got an iPhone and no light. Yeah. You get an entire studio. Just saying.
Yeah, we need to get that fixed.
I'm just saying, Tom. Just saying.
Yeah.
Maybe you can
there's a discrepancy there, isn't there?
Maybe you can let me into your studio when I'm there in a couple of weeks. Let's talk about ByteDance and Broadcom. This is an interesting alliance, given the geopolitical stance at the moment. ByteDance, Broadcom, America, China, developing an advanced AI chip. This is according to Reuters. Of course, this is all going to be within the rules that the US set in terms of those relationships. But what is this deal, this potential deal?
Well, look, you hit on two really important aspects, which is the context and the caveats around this. It will be compliant with those US laws in terms of what you can ship to the Chinese market. But you're also absolutely right to suggest that this is pretty counterintuitive, that Broadcom would want to be doing this deal, that would be risking this deal. Some might put it as a potential risk for Broadcom, working with the parent company, of course, of TikTok, ByteDance, in China to build out 5-nanometer chips. They would be designing them, Broadcom would be, and then TSMC over in Taiwan would be crunching them out and producing them, again, according to the reporting from Reuters. And again, to stress, they would be compliant. But those rules, we know, change, and they change fairly rapidly. We're leading up to that election in November, arguably potentially exposing themselves here, Broadcom. But also, I guess, the upside would be they'd have another significant client in the Chinese market.
And then let's just round off. Apple, never far from an EU warning. Now, this is, again, going at them again over their music apps. And it's not the first time, is it?
Yeah, look, this is a scrap that continues between the EU and Apple. This time a warning from the authorities, from lawmakers in Brussels, saying that they have to allow the developers of apps on their platform, on the App Store, to recommend to their customers that they can get deals outside of the App Store. Also a warning that they're looking at the fees charged to those developers of those apps within the App Store. So those two things coming in. If they're not compliant, this is all linked to the Digital Markets Act of Europe, which gives the regulators there these greater tools to pressure Apple. If they don't comply, ultimately you could get to a point where they're being fined 10% of global revenues, ultimately, but before that you'll get to a legal spat, no doubt, and this will work its way through the courts. But that is the potential implication for Apple at a time, and of course it was just a few months ago when Europe slapped a fine on them of around 1.8 billion euros over the Play system, the audio system, I should say, Spotify and others, in terms of the App Store and how they've been treating those music streaming services. And then, of course, on Friday, Apple turning around and kind of playing their own card on this and saying, we're not going to be releasing our artificial intelligence products in Europe because of security concerns linked again to the Digital Markets Act. So the spat is continuing, ramping up to some extent between Apple and the EU.
It is indeed. You don't want to be left out of what's available in the AI world, certainly not on the productivity side. Tom, thank you very much. Tom McKenzie on Big Bad Tech this Monday morning. Coming up the show, I'll bring you the results of the Bloomberg poll in the French election. That's ahead of the first round of legislative elections this weekend. Context matters on Bloomberg. It's Bloomberg Brief. A very good morning. I'm Manus Cranny in New York. Front page news for you. This is what is making headlines around the world. First up, Reuters writes about U.S. prosecutors recommended the Justice Department criminally charge Boeing. The recommendation comes after prosecutors found the plane maker had violated a settlement related to 2 fatal crashes. Next up, the UK Financial Times writes the Conservatives have lost a third of their voters since January. The poll finds the survey said 32% of people who initially said that they would vote Conservatives had since changed their minds from the start of the year. And Bloomberg News, we have our new French poll of polls, which shows Marine Le Pen's far right keeps rising. Emmanuel Macron, his party, lags both National Rally and the leftist bloc. The polls are ahead of the first round surprise elections this weekend. Let's bring Julien Ponthus. He joins me from Paris. So here we are again. I suppose a confirmation of what we already knew, which is that we're careering towards cohabitation potentially in the French system. How are investors adjusting to this level of uncertainty? Good morning.
Good morning. Quite badly, to be frank. There's been a 200 billion and over that wipeout on the French stock market. And there's very little hope that there will be a rebound or very few investors buying the dip. There's been considerable stress on the French sovereign debt that has spilled over on French banks, utilities. There's been quite a big sell-off. And as you said, the polls that you that you mentioned, they actually, we're probably going towards a majority or a win for the far right, which is, uncharted territories for France. So, yeah, a lot of uncertainty and people are bracing for more volatility.
So between now and the second round, I mean, this poll seems to be solidifying around Le Pen and Macron dropping back. Very briefly, what do we expect between round one and round two?
The big surprise, what will be really decisive is whether the centrist bloc can maintain itself for the second round. And, will we be in a situation on Monday, well, the centrist alliance or bloc will be wiped out and you'll have, a clear-cut far-right, left-wing bloc battle. That could, trigger a lot of volatility, or, will... Yep.
Well, certainly 220 billion of a wipeout in equity is already a bit of volatility. Let's see where that spread goes to on the OATs against the Bund. Julien, thank you very much. Julien Ponthus. Coming up on the show, election risks. Yes, they're there. State Street's Marvin Loh will put the context around the uncertainty in global geopolitics. From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. Tech firms race to team it up. AI partnerships are said to be brewing between Apple, Meta, and Google, and ByteDance and Broadcom. Market's attention now shifts towards the end of the week with the first presidential election debate and inflation data hitting the tape. And China and the EU agreed to hold talks on tariffs around electric vehicles. The off-ramp is building in that story. Let's check in on these markets for you. You've had 3 weeks of gains. We talked a lot about triple witching on Friday. And actually, 18 billion shares changed hands. That's 55%, double nickel higher than the average over 3 months. I want to remind you of what Erd Yardeni said. It's the roaring 20s, baby, and they are not scrambling to update their estimates. They're going for 6,000 by the end of the year, 6,500 by the end of 2025, and 8,000, stay invested, by the end of the decade. NVIDIA, it's your morning market check. NVIDIA down 1.33% now. That's adding to a third straight day of losses if it comes in on the cash, down 1.33%. We've wiped out $220 billion in value. Keep an eye on Broadcom. Broadcom and ByteDance getting together, the secret customer or the customer that was going to deliver the sauce, according to Broadcom, up 0.6%, developing the holy grail, their next advanced AI chip together. So that's on the stock side. The bonds, look, bond bulls, they're ravaged by self-doubt. Every time we trade at 425, they're a hard lot to please. They need PCE affirmation by the end of the week. They need to see a 0.1% in terms of the disinflation narrative, but it's not going to be enough to juice a July rate cut. Maybe not. Marvin Loh might have a different opinion. Issuance, 2s, 5s, 7s, $183 billion. I hope you're hungry for a few bonds and maybe some moderate duration in the belly of the curve. Dollar yen, it's getting risky. It's getting tricky. 160.17 is where the Bank of Japan intervened last. That was April 29th, we understand. The Vice Finance Minister has warned. Canada has said excessive moves, and we will take appropriate action. So maybe that keeps a lid on the dollar at around 160. So what are we gearing up for? Well, it's going to be a week of both inflation data and the guide on bets for future interest rates. State Street's Marvin Loh writes this: rate cuts to date have not been without surprises and drama. We like that. From the unexpected back-to-back moves from the SNB to cuts with reservations from it, remains clear that more cuts are coming as we enter the second half of 2024. We're lucky. He's got in the cab and he's joining me around the desk. Marvin, good morning. How are you? Good to see you.
Good morning. Nice to see you too.
So, look, the debate is, my last guest, Gerry Fowler, said, look, the reason why these rate cuts matter so is because of the shape of the yield curve, ultimately, and what that does to risk. Here we are, globally rate cuts are coming, but the betting seems to be that it will be the rest of the world, the UK and the ECB and the SNB, that will outcut the Fed. What does that mean for risk?
Well, certainly the prospects of them outcutting the Fed within the short term is true. But longer term, a lot of these curves settle somewhere around the same, where, you know, by mid-2025, end of 2025, a lot of these cut curves do look somewhat similar. So the story is still there. The timing might be different, but you know, for a global macro guy like myself, if it begins in September, if it begins in December, it doesn't matter as much as long as there are 4 or 5 cuts that come after that in succession. But
you do warn on the cadence of cuts. You do warn that it's going to be a shorter cycle and shallower here in the U.S. than we perhaps presume.
I think in the U.S. that's probably the outlier story out there. You know, certainly we're seeing weakness around the rest of the world. We're seeing transmission of policy go into their economies in a way that makes more sense. In the U.S., the fact that we're still waiting for the cut cycle to begin just shows how different our financial system is here. And then, do we have sticky inflation? Do we have fiscal concerns that drive a curve that doesn't get as steeply cut as markets expect, and as the Fed expects, actually?
And we'll deal with politics a little bit more deeply in a moment.
Okay.
I mean, we've got a big piece of theatre coming this week in terms of the Biden-Trump, the curtain raiser, round 1 in France. But I think the curtain raiser is probably the bigger issue. But here's part of the narrative that's come through with guests, which is leave the long end. They don't want to be exposed because of the fiscal risk of whoever sits in that White House next year. Yeah. Is that what makes you reluctant on long duration, but you'll take the belly?
Yeah, for sure. So long duration does reflect kind of that view in terms of how much term premium you need in the market. The belly is probably more affected by what the cadence of cuts are relative to expectations. So I could certainly see the market getting excited about cuts, but really once the dust settles, can it get as low as the market and the Fed expects? And already we're seeing signs that investors are really questioning whether or not the world after the pandemic looks like the world before the pandemic.
And you're squarely of the view that it doesn't. It's a different world in terms of inflation and in terms of transmission mechanism. We've seen that before. You mentioned term premium. Is there enough term premium in European bonds to tempt you towards there? You're neutral on duration overall.
Yeah.
But again, we've got UBS saying now is the time to be brave in terms of French assets and perhaps in duration there. Do you share that level of discount value? I mean, so many idiosyncratic stories that are out there. It does feel as if the widening of oat spreads reflects a lot of risk, if you will, particularly when the risk isn't around redenomination. It's more around how the French budget evolves, how the French relationship with the rest of the EU evolves. But in terms of thinking about, are they going to leave the Union? Is this going to fracture the EU? I don't think that's part of the story now. And there is a lot of term premium around those types of concerns. And that's what Le Pen came out really and tried to push back against when she talked about chaos was being caused by Macron, that she was not in the business of causing chaos.
And also, politics do have a tendency to not be as extreme as us analysts like to talk about in the beginning. She wants the presidency in several years also. And really breaking up, if you will, breaking a lot of things probably doesn't help that cause ultimately. So I always keep that in the back of my mind and thinking how this might evolve.
We were sat together briefly for a couple of moments earlier, and I said to you, well, politics will matter and debt sustainability will matter even more. And do we need a throwaway statement, but I want you to bring it to life on air. I said to you, does the US bond market need a Liz Truss moment to invoke some kind of fiscal discipline in this country? And what I'm saying there is that neither party, neither Biden nor Trump, would appear to have fiscal prudence as one of their top priorities, and this is part of the reason why people don't want to take that long duration in the United States of America. Do we need a Liz Truss moment in the US bond market?
You know, I don't think so. I think that we already have so much debt to begin with, and based on some of the budget revisions that we got last week, we're going to have even more debt. The buyer group is becoming more narrow. You know, certainly the U.S. has lived on the generosity of its neighbors for decades now, and the exorbitant privilege has given us that ability to. But China, they're not going to buy as many bonds as they have in the past. They don't need to. Other foreign governments, ironically, the emerging markets have been the most fiscally responsible of the governments, if you will. They don't need dollar reserves the way they used to. And ultimately, with the amount of debt that you have, you need other buyers to step in. And those buyers are more price sensitive. The mutual funds, the insurance companies, the pension funds, if you will. They're not just going to buy because they need to fill a certain percentage. They're going to buy because the price is right. So we don't need a Liz Truss moment to really get the focus on the U.S. bond market. It would certainly accelerate it. I think that there would be a lot of carnage. I don't expect that because the depth of the U.S. market is so big. But the long end could underperform, which is really what I'm looking for once we realize that the cutting cycle is not going to be as deep as it is.
Quantify underperform.
I could certainly see a 5.5% 10-year going to 6%. So you wind up with a bear steepening curve, even though we are in the midst of a cutting cycle.
And just put framework around that for me. 5.5%, 6%, Marvin, between now and the outcome of the election, Manus, or now into next year when there's a fiscal?
It's more of a mid-25 into the end of 26. The tailwinds associated with the cutting cycle are very, very powerful. We've seen that. Even though we're talking about where this all winds up, bonds have rallied fairly aggressively. So, I wouldn't want to bet against that. I wouldn't want to go overly long duration with those concerns. But once we start cutting and we realize we might not be able to cut as much as expectations, then the spotlight goes on, well, what's term premium, what's inflation volatility, and really what's the supply and demand factors around debt.
Okay, Marvin, great context. As you say, those bulls, they're ravaged by self-doubt. Got to chuckle out of you on that. They'll be even more ravaged, they'll be even more provoked with self-doubt after listening to your calls. Marvin, thank you very much. Marvin Loh setting the agenda this Monday morning in the bond market. And let's talk about debt capital markets now. Mizuho's America's head of banking says she expects more activities to come through the election season. Michal Katz sat down and spoke exclusively to our very own Sonali Basak. Let's take a listen.
We've absolutely been seeing a rebound across M&A, private equity LBOs, as well as some dribbling into the IPO markets. But activity in 2024 has not panned out as expected. Most of the activity has been highly concentrated. When you think about the M&A side of the world, 40% of M&A activity has been with mega transactions, whether it be in the energy space, TMT, financial institutions. On the LBOs, we've certainly seen some of that. But when you take a look at the broader M&A volumes, private equity has still, I would say, on the sidelines, constituting 25% of overall activity compared to the 35-40% that we have seen in recent years. So certainly a rebound, but there's a lot more pent-up demand. There was a Bain study that came out and said that there are 28,000 portfolio companies sitting in private equity firms, 40% of which are 4 years or older. So there is clearly, I would say, demand to monetize some of those. Also, as we know, private equity had raised massive funds, which they have yet to deploy. So we're beginning to see some early days of activity, but hopefully there'll be more to come as we get through the elections and beyond.
The 28,000 companies there that are ripe for exiting, is that how you look at the potential base of future clients?
Part of the base of future clients. As I mentioned earlier on, we do focus on publicly traded companies, which have been very active participants in deal activity. They're well capitalized, and there is an opportunity for them to achieve synergies in pursuit of growth, innovation, as well as consolidation. That's one area. Second is the private equity world, which we just talked about. But let's not forget that there are also 1,400 unicorns in addition to other cohorts of companies that have been funded by the venture capital community, which are similarly looking for an exit in what has been a rather muted IPO market. And so when we take a look at what is the potential client base, it does span companies all the way from the venture side, or I would say growth venture, to the private equity, as well as publicly traded companies, mid-cap as well as large cap.
Mizuho America's Michal Katz speaking exclusively to Bloomberg's Sonali Basak. Context matters every day on Bloomberg. This Bloomberg Brief. I'm Manus Cranny in New York. China and the EU are agreeing to discuss the bloc's plans to impose additional tariffs on Chinese EV imports, including taking the levies to as much as 48%. Now, this comes as the German Vice-Chancellor, Robert Habeck, wraps up his trip to Beijing. For more, let's bring in our trade czar, Brendan Murray. Brendan, Habeck is hoping to deliver an off-ramp for the European side here. What do we understand has happened?
So what we think is going on is that China, between now and November, when these tariffs are supposed to take effect, is going to put the full court press on EU members to try to get them to back down. Now, that could be a divide and conquer kind of strategy. It could be, offering incentives. We'll build plants in Europe if we have to. But for what we're going to see is a real high stakes game of geopolitics between now and November.
And on the Chinese side, where are they? They're locked out of America in terms of the tariff regime here on EVs. How important is Europe to them? I mean, in terms of expanding and growing the EV business for them, what is it that they're going to be driving for?
Yeah, I mean, it's Europe is the whole ball game for China right now. As you said, the U.S. is basically locked Chinese EVs out of the market, and if they can't sell into Europe, there's going to be a lot of surplus electric vehicles made in China dumped into the world economy. China's making some headway in Latin America. We've seen some figures come out this morning that shows that they really are selling at almost triple-digit. They're exporting at triple-digit rates to places like Brazil. So, but the real kind of crown jewel in the global economy at the moment is the European economy. We've seen BYD dealerships open up in the UK even. So if the tide starts to turn against Chinese electric vehicles here in Europe, then it spells big trouble for that important industry in China.
Brendan, thank you very much. Certainly the automakers reacting a small amount in Germany this morning on the back of this, that there may be just a little bit of an opening of discussion. Here in the US, we've got the first presidential debate between President Biden and the former President Trump. It's scheduled for Thursday. It will be in Atlanta. Joining me now to break down what we can expect is Kriti Gupta. Kriti, good to see you. I'm just looking at Politico here. Trump taking broad swipes at Biden, being held up in Camp David over the weekend to prepare for this. I mean, disparaging, to say the least, in terms of the moderators, Dana Bash and Jake Tapper. So how much and how important will this first debate be? Who's got what to win here?
Well, it's all about clarity, Manus, because a lot of the policy agenda, at least critics of it, have been that their policy agendas aren't actually that different, specifically when we're talking about how they're dealing with the rest of the world. Both presidents, President Biden and President Trump, have talked about increased or decreased NATO spending, for example, and having Europe pull up more of its weight, getting to that 2% of GDP target. They've both talked about being tough on China in different ways, bringing some of that international manufacturing capacity, specifically around chips, onto U.S. soil. They've just done it in very different ways. For a financial audience, Manus, I think what's important to keep in mind is you're also hitting a budget deficit ceiling. That's really important. It's the first thing on the president's docket. So when people are going to be parsing for is, one, the tariff story. What does that look like under whoever becomes president next? And second, how do they fund it when the deficit is only growing?
And how much will immigration play in this debate? Again, Trump over the weekend, a number of sort of highly speculative things that he suggested, talking about immigrants again and talking about a championship fighting league for immigrants. I mean, it's sort of very inflammatory language. Will it play hard on the agenda?
This may be the make or break moment for both presidents, actually, because it is such a hot topic issue in the states for a variety of reasons. Now, this isn't just an immigration story relative to the southern border. This also has to do with things like H-1 visas, for example, student visas to international students, specifically coming out of India, China, for example. What does that workforce actually look like specifically in the tech sectors? Not to mention the manufacturing one. Of course, to your point, Manus, this is going to be a really big issue. It's also going to feed into how a lot of economists view the labor market story, especially when it comes to the Federal Reserve. That could be a game changer in terms of just how much support the labor market actually has.
Okay, Critty, all eyes down. There'll be a lot of speculation between now and when that debate actually hits the airwaves. We'll be watching it. We'll be glued to it. Critty, thank you very much, Critty Gupta, on the upcoming election debate. Nice sports story for you now. We've got Tiger Woods. There's a vehicle that he has. It's called Tomorrow Sports. It's been valued at $500 million. The co-founders, you've got Tiger Woods and Rory McIlroy. They've just secured funding from Dynasty Equity Partners. And the company's first project in this partnership with the PGA is for an indoor golf league known as TGL. That's going to be scheduled for launch in January, and it will air on ESPN and ESPN Plus here in the United States of America. The capital injection will fuel expansion into new formats, leagues, territories, and media properties. Of course, I mean, you know, the picture that you've got there is a trio of smiling people. I'd be smiling if I got $500 million in backing from equity investors. Let's talk to you about markets, whether this roaring rally can continue. As Ed Yardeni says, it is the roaring 20s. You've got equities a little bit better flat this morning. And bond market, you've just heard from Marvin Loh there from State Street, in a scenario where you could see yields going back to 5.5–6% in bonds. That's on State Street this morning. Playback for that conversation. And the dollar trades down 1/8% this morning. A lot of talk about potential intervention on dollar yen. Good morning. Coming up, we will talk about that presidential debate. And of course, the bond bulls. They want to see what the inflation data is at the end of the week. Context matters on Bloomberg. Good morning. It's Bloomberg Brief. I'm Menace Crenny in New York. A look at the rest of the week. This is what we've got for you. San Francisco Fed President Mary Daly. She'll speak at 2 p.m. today, Eastern Time. Thursday, it is that all-important piece of theatre. It is going to be the President Biden and former President Trump go head-to-head in their first presidential debate. And then we get the second round out of the way. I'm talking about the PCE. The numbers will come through as well for personal income and spending on Friday. That's going to be critically important to the bond market. Some micro movers for you. You've got Coinbase, crypto-linked stocks under a little bit of pressure here. Bitcoin is slumping and has been under pressure. You got RXO jumping. They've agreed to buy UPS's brokerage business, Coyote Logistics, for $1 billion. But the macro mover of the week will be where the bond market goes. 425 is perhaps the most difficult level for the bond market to keep its attention at. As you can see here, we're at 425 at the moment. We just had Marvin Loh from State Street talking about the lack of term premium in these markets, and he can see a confluence of events that can take you through to around 5.5–6% next year in the bond markets. What you have here is a bond market ravaged by self-doubt. They need the PCE to come in at 0.1%, again on a consistent basis, but nobody believes that July is the open month for a rate cut. You've got $83 billion worth of bonds, 2s, 5s and 10s all coming through this week. So we'll keep an eye out on that. That was your Monday edition of Bloomberg Brief. A lot of food for thought from UBS saying now is the time to take advantage of the deep discount in French assets, including the banks, and Marvin Loh warning you, a prescient warning, that yields could re-spike when the market realizes the Fed can't cut just as much. Context matters on Bloomberg. Good morning from New York.